Hello and a warm welcome to the Open Treasury Podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by ctmfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta, Executive Writer at CTM File. Joining me today are Anthony Carfang, Managing Director of the Carfang Group, and Paul Galloway, Senior Advisor at Strategic Treasurer. Welcome back to the Open Treasury Podcast, Tony and Paul. Thank you for taking the time to share your thoughts with us on topics that impact corporate treasury. It's time to get some deeper insights from you on your opinion about topics in corporate treasury, namely currency management, cross-border payments, Eurozone recession, artificial intelligence, and data breach. You can read these articles and also research content more deeply by visiting ctmfile.com or by following the links in our show notes. Our first theme for today is about managing currency volatility and uncertainty in 2023. Last year was a challenging year for corporate finance and treasury, and managing currency volatility and uncertainty is likely to dominate the list of priorities for corporate treasury again in 2023. Tony, I read your quote in an article published last year in the Wall Street Journal, which is about companies reviewing hedging strategies in light of the higher currency volatility and interest rate hikes across the globe. Given that corporate treasury is expected to ramp up automation efforts this year, Tony, what would you recommend treasury and finance professionals do to navigate currency exposure risks while enhancing their organization's value?
That's an outstanding question. This past year has seen a lot of volatility. The U.S. raised its interest rates faster than countries around the rest of the world, which sent the dollar soaring. And then as other countries caught up, the dollar has declined. And we don't know where that's all going to shake out. So we still expect currency volatility. If I were a treasurer today, the first thing I would do is consult with my board to make sure we're on the same page about the degree of risk we want to take and the amount of expense we want to incur in our hedging activities. Once I know that, then I can develop two things: a forecasting plan and an overall automation plan for dynamic hedging of my currencies. The forecasts are essential because that tells us the principal amount that we may need to hedge. And then automation is important for that because as the hedging ratios change over time, we need to change our hedging exposure. We can go into a lot of detail on that. There's an awful lot to unpack there, but talk to the board, make sure we're on the same page, and then forecast, and then dynamic hedging technology.
Would you concur with Tony?
Definitely great points. I think there's still a lot of uncertainty ahead of us in 2023 in terms of FX volatility. The Fed took a downtick on their interest rate rises. They may be kicking themselves that they didn't hold steady at 50. We just saw jobs report that was, blew out expectations. I think there's still a lot of inflation out there in the system that we got to work through. So I think there's going to be continued volatility. So the question is, for an organization, what are they willing to accept? Some organizations are much more active at FX hedging today. In terms of, automating what they do, I'm all for that in any fashion, any way that you can automate what you're doing to programs like this. You absolutely should look into that. I think they can be cost effective. They can help you hedge risks effectively. You can set, guide rails that help you just be able to, one, monitor, but two, be able to make decisions without maybe necessarily making a decision too soon or too late. What we're seeing today with organizations, or at least what I've seen out there, and Tony, you may have seen a lot of the same. We've got clients that have gone 10, 15, 20 years without changing systems, processes, protocols, and they're starting to invest money into changing things. For some of these organizations, they're trying to do everything all at once, which is almost nearly impossible to do. You've got to select something as a priority and move forward. And some organizations are thinking about this. They're either engaging in doing it, and some have already done it. But, to Tony's point, I think you got to get buy-in from, your board, your senior management team about what's acceptable for risks and how to move forward.
Paul, you really put your finger on something in terms of installed technology now being very old. After a decade and a half of almost zero interest rates, the cost of making a mistake in Treasury were pretty small. You had idle cash, but you didn't lose anything because you couldn't have earned anything on it anyway. That has changed overnight. How far that goes, we don't know. Similarly, the cost of hedging has gone up as volatility has increased. The optionality comes with a high premium. So the equations that worked in 2019 or 2018 or 2017, and the technology that fed those equations, those processes, are if it worked in 2017, then it does not work today.
Yeah, agreed.
If it works in 2017, it doesn't work today. Those are wise words. Moving on to the next story, which is about FV Bank, the US licensed global digital bank that has announced the launch of its cross-border foreign exchange payment service, enabling clients to execute frictionless international payments in 7 currency options across over 15 countries. Given what you know of the FV Bank's cross-border payment service, and also the fact that regions and organizations across the world are working to lay the groundwork for instant, frictionless, and interoperable international transactions so that it can power a whole range of new opportunities for financial institutions and corporations, Paul, if I ask you to go first, do you think we're entering a new era in wholesale cross-border payments that will cut through borders and help grow it at a staggering rate?
I hope so. My experience with trading some of these currencies, just looking at the list here of these 7, particular Japanese yen. First time I did a trade on Japanese yen, I didn't realize some of the gating fees associated with that. So it was not without friction. And so the ability to trade currencies like this is appealing to me. So interoperability, APIs, the ability to trade or move currencies at a quicker pace or a smoother pace is certainly interesting. The other thing that, I like about this, I think about some of my prior organizations I work for, just the currencies that we held on the books sometimes. You might have negative interest rates that you have to pay on. That's certainly something that you don't like when you're upside down on a currency position. But sometimes you have rationale as to why you might hold FX. Maybe something like this allows you the ability to be more on demand with currency. You might not have a need to hold currency on the balance or on the books unless you really want to. Maybe you're taking a position on it. I don't know. Some people do that, right? They go long on currencies for whatever reason. This is kind of an interesting play. I can be short on currency and be able to trade it effectively and efficiently. I find that appealing.
It was only a couple decades ago when the issue with cross-border payments was not how much it would cost and how much friction there would be, but whether or not the payment would arrive at all.
Right.
So we've actually come a long way in 20 or 30 years. Now that it certainly does arrive, friction is an important issue because any timing delays introduce risk. Risk of market changes, risk in the changes of the credit quality of the counterparty or the intermediaries involved. And obviously the more intermediaries that are involved in a payment transaction, the greater the opportunity for something to go wrong. Now, central banks and payment networks have really closed the gap on that. And conversation these days is now between immediate payments and instantaneous payments. As we know from the high frequency traders on Wall Street, fractions of a second can result in fortunes being made or lost. So that's clearly important. Now, with respect to FV Bank, it's a Puerto Rican licensed financial institution that is attempting to get a Fed master account. With that central bank account comes all the backbone that you need to just catch up to the current banking systems that the major banks employ. And I think the interesting twist with FV is that they're also looking at cryptos in the equation so they can accept a crypto and immediately redeem it out or pay it out in other currencies. It strikes me that there are a lot of bridges to cross before that happens. The thinking is right. The implementation, it's not at all clear that the Fed will grant them a master account. And there are certainly dozens of other organizations who are seeking master accounts that are probably more well known to the Fed, probably better capitalized, and probably already under some U.S. jurisdiction and supervision that may put them in front of FV in line for that master account. But we don't know. My guess is with the demise of FTX, any application for a master account that has crypto in the name does not go to the front of the line.
Yeah, Tony, you bring up interesting points there. I think about decentralized finance, centralized finance, making that connection across the two. Fiat currencies aren't going away. Cryptocurrencies aren't going away. I just think the ability to make a connection across the two like this becomes quite interesting. So if they're able to pull that off, my hat's off to them, because I think it's the first step forward for something that's going to be much broader down the road.
Exactly. I agree. Yeah, the thinking is correct. And ultimately, like trading from dollars to euro should be, equivalent to like trading from Bitcoin to Ethereum to dollars. It's all the same problem in a sense. The mechanics of doing that, at least today, require central bank access.
Central bank access. And our next story is also connected with central bank access, which is about Eurozone facing a recession risk and financial fragmentation. According to the Economist Intelligence Unit's latest report, Global Monetary Policy in 2023, the ECB, or the European Central Bank, will have ramped up its interest rates by 400 basis points in the 12 months from July 2022 to June 2023, which is more than double the pace of the last significant tightening cycle between 2005 and 2008. As the ECB eased the pace of its interest rate hikes in December last year and laid out plans to drain cash from the financial system to fight against inflation, the bank significantly revised up their inflation projections to an average of 6.3% for 2023 and 3.4% for 2024. ECB's hawkish posture raises recession and fragmentation risks within the Eurozone. Tony, do you think the ECB will be able to combat inflation without prompting a deep recession? And if the Eurozone, according to you, is pushed into a recession, how will it impact US corporate treasury?
Push, there's an awful lot in that question. So first of all, the ECB is very hawkish. They are more hawkish than the Fed. They were actually late to the party. So the Fed began tightening before the ECB did. But now the ECB has made up for lost time and is pushing new boundaries, which definitely deter economic activity. In addition to interest rates rising, the unwritten story is the contraction of the ECB's balance sheet. The Federal Reserve began contracting its balance sheet, and it announced a policy of reducing its balance sheet by about $95 billion a month. And over the last 6 or so months, has reduced its balance sheet by about $1.5 trillion from 8.9 trillion down to 8.4 trillion. The ECB, again, being a little late to the party, though, has really slammed on the brakes and dropped its balance sheet from about 9 trillion down to 7.8, which is like a 12% reduction in the size of the ECB's balance sheet in a 6-month period. When a central bank's balance sheet is reduced, that has the effect of draining reserves from the system and ultimately lowering money supply. As our statistics have shown here at the Carfang Group, there's about a 98.5% correlation on a 9 to 15 month lag between M2 money supply and GDP. We are still in the last stages of the stimulus. 9 to 15 months ago, the balance sheet was still rising, the money supply was still rising. So we're in completely uncharted territory. To think that the balance sheet has been reduced by 12% will ultimately have an effect on the money supply, will ultimately have an effect on GDP. And, as I look at it, the ink is all red.
Well, Tony, it's kind of this game that central banks play to try to control what's going on, to your point, inflation, utilization of interest rates, balance sheet, all these tools and levers that they have to try to get things under control. They're using historical data that provides them some indications of what's been going on and trying to project to make an understanding or a decision around what the future might look like with the actions that they take. What we've historically seen, whether it's Eurozone or U.S. Fed, is central banks sometimes have a hard time getting it right. They either undercorrect or overcorrect, take too much action, take no action. The one thing I do see, and I absolutely agree with Tony, is that there's still this euphoria that's out there. You can see it in the markets today even. Things are still rosy and look great, and it's all good. It's all good until it's not good, until they realize, access to capital is a lot harder today. It costs me a lot more. The money supply has shrunk, so now it's finite compared to, 0% interest rates. I had access to it anytime I wanted. I think there's a lot of pain still left out there in the markets. We haven't seen the worst yet. I expect that, we will start seeing some red ink hitting the books here real soon.
Yeah, and to take Paul's point one step further, you correctly brought up access to capital. As liquidity drains from the system, what happens is credit spreads widen. Mm-hmm. So the highest credit-worthy borrowers will still have access to capital, albeit at a higher rate. The lower credit quality borrowers will conceivably lose access to capital at any reasonable rate. And that is what defines recession.
There's a lot of food for thought there. Moving forward to our next story for today, which revolves around a survey of institutional traders conducted by JP Morgan, in which AI or artificial intelligence and machine learning have been reportedly cited 4 times more frequently than blockchain and distributed ledger technology as having the greatest anticipated impact on trading over the next 3 years. Financial industry executives' perspectives have reportedly changed as a result of the turbulent crypto bear market, with added enthusiasm surrounding AI technology such as ChatGPT. Paul, given the excitement around ChatGPT, AI, ML, blockchain, distributed ledger technology, do you believe that AI and machine learning will have over the next few years a greater impact on corporate treasury than blockchain and distributed ledger technology or DLTs?
APIs have been out there for some time. However, the adoption and creation of a data bank, for lack of better terms, a bank of APIs. The top tier banks, a lot of them have APIs in their wheelhouse already. They still have a few, I think, that they're working on, but they've got quite a few in place. You start dipping down from there, and a lot of the other banks, they're way short on APIs. And I think about technology in the treasury arena. We're seeing providers build up their bank of APIs, where I think maybe this survey shakes out when it comes to artificial intelligence and machine learning is around a couple areas. One, the use of APIs to integrate and automate things, the ability to create forecasting that's more dynamic. Spreadsheet forecasting, what we've historically done for a lot of organizations, we're hopefully knock on wood, we're going to be seeing that go to the side. And the utilization of AI and machine learning, I think over the next couple of years are going to be adopted more readily because it's growing and it's more in place and available for people to utilize today. Do I think blockchain goes away or won't pick up steam later down the road? I think it will. It doesn't go away. I think it will pick up more steam down the road. I think there's just going to be a focus by corporates and other entities on the machine learning AI. And I've heard a lot of that out there and talking with clients. They're focusing on that today. They're looking to get, their forecasting in better shape, their reporting in better shape, their analytics in better shape. And these tools will help them do it.
So Push, I actually see blockchain and artificial intelligence as two very different animals. And I look at blockchain as plumbing. How the things happen, how the things get recorded, how the things move, how ownership and custody take place, whereas artificial intelligence refers to the decisions that need to be made, irrespective of the plumbing. And I'm not at all surprised to see artificial intelligence moving front and center. And to me, the quality of the artificial intelligence is in the richness of the database from which the machine learns. And as technology continues to improve, data storage costs go down, the cloud expands, databases get bigger, and therefore the quality gets bigger. In the most pure sense, AI has been around for an awfully long time in corporate treasury. A sweep account that says, if my balance is greater than X, transfer Y dollars from investment A to investment B.
Right.
That's artificial intelligence because the machine has decided that rather than the treasurer sitting down and making that decision. And that's based on data the treasurer had. Cash forecasting would be a higher order level of artificial intelligence, or machine learning that has been perfected and gotten better and better over the years. I think when we have a really robust database that feeds the machine learning, then we actually get to the point where not only can the machine make optimal decisions for everything that happens in the treasury, but capital structure, debt issuance, equity issuance, hedging, who knows what, but it actually gets to the point of telling the treasurer what questions to ask. So it's not simply answering the treasurer's questions, but thinking ahead. That is a whole new world for us. And I think it's very exciting. But, sweep accounts were basically a machine substituting for the brain of the cash manager based on data and the experience of the cash manager. And you simply take that now 8 standard deviations out, and that's where we are today. And who knows where that's going to lead. I'm excited about it.
The fifth theme for today's discussion is about Swiss federal authorities investigating a 2022 data breach involving thousands of former Credit Suisse clients who'd reportedly held US $100 billion with the bank. The breach reportedly exposed more than 18,000 accounts, including those of fraudsters, human rights violators, and businessmen who were subject to penalties. According to the Swiss prosecutors, the accused offenses in this case include breaking banking secrecy regulations, causing harm to Credit Suisse, and disseminating private company information to foreign organizations or their representatives. Now, Tony, what worries me about data breaches is the latter part of disseminating private company information to external organizations or their representatives. So, Tony, given your experience, could you recommend one or two methods that can help corporates or corporate treasury reduce data breaches?
I take a little bit different view of this whole thing. And the article is fascinating. From a strategic standpoint, every company needs to absolutely protect its core competency and must do everything it can to defend that which brought it to the dance. In the case of Swiss banking, for centuries, its core competency has been secrecy.
Right.
And a data breach is an absolute violation of the most central tenet of Swiss banking. So when I see Credit Suisse involved in a data breach, the walls come crumbling down. That is the reason for being. That is why Capital or Bank in Switzerland.
Right.
Now, to your direct question, obviously, corporate treasurers need to protect their own data within their walls. That has one sort of protection that is directly within the control of the corporation. But outside the walls, as their data flows through financial institutions, it just requires an extra measure of due diligence on the financial institution to make sure that that institution has the appropriate data security protocols in place. I don't think there's any foolproof way to do that, though, Bush. Secrecy and privacy have always been an issue, and you just have to do your due diligence on your service providers.
Yeah, Tony, I think you hit the nail on the head. That's directly where my mind went to as soon as you said that. I've been there, and vetting the counterparties is so important. Making sure they have the right controls in place, looking at their SOC 1, SOC 2, looking under the hood, kicking the tires, asking the right questions, making sure that from point A to point B, that the encryption and the integrity of the data is held tight. And as soon as it hits one point, that it's moved to another point securely within an appropriate amount of time. Organizations can do the controls on their end internally, like you said, and they should be, right? It's working with your IT folks, is ensuring you have the right controls in place to make sure that you don't have a single person that has access control, and then all of a sudden they have incentive to do something that they shouldn't do, which is steal money from the organization. And it happens all the time. So that's internal. But once it goes external, organizations lose control. And so as a treasurer, that's the kind of thing that would keep me up at night. I like to sleep well, so I like insurance policies. And the way I get that is with those third parties, I'm spending a lot of time, and I'm bringing in people in my own organization who are experts in those areas. We're grilling them. We're looking at information. We're getting confirmation that they have all the right tools to ensure that the data that's coming to them or coming from them back to us, because it will work both ways, is secure. Even with that, it doesn't mean that a data breach might not happen, because fraudsters are becoming more and more sophisticated. They're finding backdoors and ways to get in and steal data and information from organizations in all kinds of ways. If you aren't taking the steps, boy, you're really exposing yourself to a possibility that, you've got a breach, and that's not a good thing.
Paul, you and Tony, to my mind, made a very pertinent point, so far in the discussion, which is to ask the right questions. And I hope our audience is paying attention to whatever you said so far, including asking the right questions. And finally, I'd like to ask both of you, what is your choice for the biggest or most important story of the past week and why? On CTM File, this could be something that you read on ctmfile.com or anywhere else. If I could ask, Tony, you to go first.
Okay, that's a challenging question because there are so many stories and things are breaking so fast. To me, one of the biggest surprises was the Bureau of Labor Statistics employment numbers that came out last Friday that were 500,000 new jobs versus 100,000 that were expected. And how can you be off that much? But the real issue is the household survey just a few days before showed a very different picture. And my question is, why are the data diverging? Why are two different methodologies leading to two very different answers on such an important statistic? And that was further compounded by the announcement from the Bureau of Labor Statistics that they are now going to revise the way they compute the consumer price index. Well, gee, we're all concerned about inflation, so let's change the data. My goodness, how can this be?
Wow, Tony, it's hard to argue against that being, one of the biggest stories out there. I mean, it was one of those things that's like a perfect storm, because you have the Fed doing a 25 basis point rate hike. People are sitting there going, okay, things are better. Markets start taking off again. And all of a sudden you just get socked in the gut with, man, jobs just went nuts. And nobody anticipated that. I remember 6 months ago, I was doing a presentation to the Iowa AFP. And I was sharing with folks. I was like, listen, inflation is a serious issue, and there's going to be pain associated with that. And it's going to come in the form of jobs. Yeah. If we aren't seeing a sharp decline in jobs, then we or the Fed, they're not doing their job to get things cooled off. That's not a good sign. And, you can't just all of a sudden mid-step say, oh, we got to change this calculation that's been the same for like ever, right? It makes zero sense. I don't understand that. It's mind-boggling.
There's so many places to take that. We're in an environment where the Federal Reserve's balance sheet is now like 35% of the total US GDP. In the Eurozone, the ECB balance sheet is 65%. Well, what has happened is the central banks have completely taken over the markets and crowded out the private sector. And what that does is eliminates the market signals. The data that we're getting from the market is distorted because of the distortions. Conceivably, the labor number was just distorted, not because there were more jobs created, but the amount of subsidies to those who weren't working has shifted in some way, and that changed the denominator, not the numerator. It's just really difficult. I spend a big part of my day going through those numbers. And to see them revised month after month, or to see something that looks like it went up, but when you peel back the onion and take out the the extraneous items, actually went down. And I'm seeing more and more of that. Frankly, it's very disturbing, because this is the same data that our policymakers are making policy with.
Thank you, Tony and Paul, for your time and your valuable insights and informative analysis. We would also like to thank our CTM File audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you. This podcast is provided for information purposes only, and statements made by CTM File or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.